Morning, my 111 students. So this video is actually on the preparation of worksheet for a merchandising type of business. So the worksheet is still like your service type concern of business. It has 10 columns, money columns. So the first two columns is the unadjusted trial balance column. So the steps are similar actually. So the first thing you should do is to copy the account titles of the general ledger arranged as line first, current assets, current non-current assets, and then current liabilities, non-current liabilities, then owner's equity, which is the capital, and then the drawing, then all income and all expenses for the last. After that, the balances of each accounts that are either in the debit side or in the credit side are to be placed in the money column of the debit and credit. So in which side it occurs as the balance. So normally the balance is in its normal side or normal balance side of the account. And you notice that when you total the debits and the credits, the amounts are equal or of the same. After the unadjusted trial balance is the adjustments columns, which is also has a debit and credit column. So just like or similar to your service type concern, there is a given data which usually labeled as additional adjustments from letter A to letter E or numbers 1 to 5, or it depends upon the given information how many items need adjustments. So in the worksheet Excel file I have given to you as a sample worksheet, we have posted there adjustments of letter A to E. And you notice that B to E has been posted because I don't have to emphasize those because those adjustments are similar to what you have prepared in the previous worksheet preparation on your service type concern. So what I am trying to emphasize here is the data letter A, in which it stated that the merchandise and the inventory physical count has amounted to 532,000. So that is the emphasis. So as you can notice in the worksheet Excel file I have uploaded with you, um, the letter A on ending inventory has not been posted in the adjustments columns. So please take note, the merchandise inventory physical count ending was not posted in the adjustments column because it is to be extended immediately in the income statement and balance sheet column. So we are using the direct extension method actually. So later we will continue discussing on that. So in here, the adjusting entry should be prepared and then posted in the adjustments column except for the data on ending inventory in which, as I said a while ago in our example, that's letter A data on our Excel file of worksheet. And you notice that when you total the debits and the credits of the adjustments column, the amount is the same. So they are balanced. And for the preparation of the adjusted trial balance columns, so to compute the balance of each account title, this is the guide. So original balance or the debit balance plus the debit adjustment, that is equal to debit balance. If the original balance is a credit balance and then the adjustment is credit also, so credit balance plus credit adjustment is equal to credit balance. So add. And then if the original is a debit balance but the adjustment is a credit one, so the debit balance original less the credit adjustment, and then the result is the balance, which should be placed in the side in which it is higher. And another thing is that if the original balance of the account title is a credit balance and then the adjustment is a debit adjustment, so you have to deduct it. So original credit balance minus the debit adjustment is equal to the account balance, which should be placed in the side in which it is higher. And after that, the adjusted trial balance, total the debits and then total the credits, and you have to notice that the amount of the debit and credit is equal or the same amount. And then we will proceed with the income statement extensions. So once again, income statement extensions is similar to what you have prepared on your worksheet preparation of the service type of concern of business. However, in here, there are a lot of income statement account titles compared to your service type. So, let's say, for example, so the items or account titles that should be extended in the income statement columns are the sales discount, sales returns and allowance, purchases, purchase returns and allowance, expenses, and other income accounts are extended in the income statement. So just place it on the side in which it appeared in its adjusted trial balance. So the adjusted trial balance is the one that is to be extended. Next, you have to emphasize or notice that the merchandise inventory beginning is extended in the debit side of the income statement because it is considered sold, while the merchandise end given in the additional data in letter A, which is 532,000, is placed in the credit side of the income statement because it is not yet sold. So please take note. Under the direct extension method, the merchandise inventory beginning is extended in the debit side of the income statement, while the ending inventory is extended in the credit side of the income statement. And then in addition, in the balance sheet column, the merchandise ending inventory is extended in the debit side of the balance sheet. So, and then after that, so total the debits and total the credits. So, the amount is not equal. It represents either net income or net loss. So, the difference is either a net income or net loss. In the event that the total credit is higher than the total debit, so the amount of difference is actually the net income. Then that difference is to be added on the debit side of the income statement. Then, when you get the total, it should be balanced now. Balance sheet extensions. So, similar to your worksheet preparation of service type, so all assets, liabilities, and owner's equity are extended in the balance sheet columns. So, and to be emphasized, as I mentioned earlier, the amount of merchandise inventory ending is to be placed or extended in the balance sheet column. So, and the beginning inventory is not extended in the balance sheet. After that, you have to total the debits and credits. Then you notice that the amounts are not equal. The difference represents the net income or net loss. So when the debit side is higher than the credit side, it means there is net income. So the amount of difference which represents net income is added on the credit side of the balance sheet column because net income actually increases capital. Then when you get the total, you have to notice that it should be balanced now. So your worksheet now is complete. So double rule every bottom amount of the money columns. Preparation of the income statement for Chat Novelty Store in your same example. So we have it here. Net sales. Net sales amounted to 2,626,000. So please take note that this net sales has a notes to financial statements. This is note 1 because the detailed presentation of net sales computation is to be revealed in the notes to financial statements. So actually, this is gross sales, less sales returns and allowances, and less sales discounts. The next is deduct cost of sales from net sales to arrive at the gross profit. So cost of sales is actually note number 2 because this 1,612,000 cost of sales is computed and the computation is revealed in the notes to financial statements in which the computation of this we will discuss in the next slide. So net sales less cost of sales is equal to gross profit. And then deduct from the gross profit all the operating expenses such as salaries expense 336,000, advertising expense 61,000, rent expense 26,000, office supplies 53,000, insurance expense 18,000, depreciation expense 25,000. So total operating expenses amounted to 519,000. Deduct it from the gross profit of 1,014,000. So your net income is 495,000. The statement of changes in equity. So the heading, of course, and then capital beginning in the given information in the SIM is 517,000. Add net income 495,000, then total 1,012,000 less drawings 87,000 is equal to capital amounting to 925,000. So the balance sheet. So current assets, cash, accounts receivable, so 31,000 and 83,000. Merchandise inventory, which is the ending balance of 532,000. And then prepaid insurance, 36,000. We have office supplies, 15,000. And then add, so the total current assets amounted to 697,000. Non-current assets, office equipment that is net. So we have the 370,000 minus 75,000 is equal to 295,000. So 697,000 current assets plus non-current assets of 295,000, total assets amounted to 992,000. Liabilities and owner's equity. So current liabilities is composed of accounts payable 58,000, salaries payable 9,000. So total current liabilities is 67,000. Capital end, as we computed in our statement of changes in equity, amounted to 925,000. So plus current liabilities of 67,000. So the total liabilities and capital amounted to 992,000. So your accounting equation of total assets is equal to total liabilities and capital is balance or equal. The notes to financial statements, as I said a while ago. So note 1, your net sales. So gross sales to 675,000, less sales returns and allowances to 26,000, less sales discount 23,000. So your net sales is 2,626,000. Notes to financial statements. Another number 2 is cost of sales computation. So to compute your cost of sales, this is the formula or the format. So beginning inventory of 627,000 and then add the net cost of purchases. So to get the net cost of purchases, gross purchases of 1,512,000, deduct the purchase returns and allowance, which is 14,000, and then deduct the purchase discounts, which is 19,000. So when you get the gross purchases less purchase returns and purchase discounts, that's actually the net purchases. And when you add the freight in, that is now the net cost of purchases. So the net cost of purchases is 1,517,000. Add to the beginning inventory, so the total goods available for sale is 2,144,000. Less merchandise inventory end of 532,000. So the cost of sales or the cost of goods sold is 1,612,000. After that is the preparation of the closing entries. So closing entries, close income statement accounts with credit balance, and then second step is to close the income statement accounts with debit balance, and then close the income summary and close the drawing account. So step 1, to close the income statement accounts with credit balance. So debit sales, debit purchase returns, debit purchase discounts. So as you can notice in the worksheet, these are the account titles that are on the credit side, and then credit income summary, because income summary is the temporary account title to be used in closing income and expense accounts. And then after that is before we close the expenses on the purchases and other account titles, we have to establish first the ending inventory, because the ending inventory is not yet sold. So it's not part of the purchases that has been sold. So debit merchandise inventory end 532,000 and credit income summary. So most of the time, the closing of the IS accounts with credit balance and the establishment of the ending inventory is prepared an entry that is compound. So they will be done together. So if they go together, so your entry could have been sales 2,675,000, purchase returns 14,000, purchase discounts 19,000, merchandise inventory end 532,000, and then credit income summary amounting to 3,240,000 because you will add a 2708,000 and the 532,000. So if you prepare the compound entry, but it can also be acceptable this way. Next is to close income statement accounts with debit balance. So, sales returns and allowance is a debit balance of 26,000, so you have to credit it. Sales discounts, also a debit balance, 23,000. Merchandise inventory beginning is of a debit balance, so 627,000. Freight in, purchases, salaries expense, advertising expense, rent expense, office supplies expense, insurance expense, and depreciation expense. And then all these account titles with debit balance, you have to add, and the total of that is 2,745,000. So debit income summary 2,745,000. So this is the entry to close income statement accounts with debit balance. And then to close the income summary account, so our income summary has a credit balance of 3,240,000 and then we debited amounting to 2,745,000. So the difference is 495,000 credit balance. So to close income summary with credit balance, so debit income summary 495,000 and credit capital 495,000. And then the drawing of CHA is to be closed. So it shall be deducted from CHA capital. So debit CHA capital 87,000, credit CHA drawing 87,000. So that's the entry to close the drawing account. And after the closing entries is the preparation of the post-closing trial balance. So you will notice that the post-closing trial balance is also in a trial balance form. However, there are no longer income accounts and expense accounts. So it only has assets, liabilities, and capital. So cash 31,000 debit, accounts receivable 83,000 debit, merchandise inventory end 532,000, prepaid insurance 36,000, office supplies 15,000, office equipment 370,000, accumulated depreciation 75,000, accounts payable 58,000, salaries payable 9,000, capital 925,000, so that's the ending balance. So total debits 1,067,000 and total credits 1,067,000. And as you can remember, in your service concern type of business, you also prepare the reversing entries at the end of the accounting period. So you don't have to worry because the reversing entries follows the same rule as your service type concern. So you will only reverse adjusting entry that increases an asset or increases a liability. So I think that's the end of the topic or discussion on worksheet. Thank you and God bless. So once again, for you to go over with the Excel file worksheet sample I have uploaded, just always remember everything is actually similar in process with your service type concern. The only emphasis I gave is on the information letter A, which is on the merchandise inventory physical count ending, which is 532,000. So the emphasis is that it shall be extended directly in your income statement debit. The beginning inventory is extended in the debit side of the income statement, while the ending inventory end is to be extended in the credit side of the income statement and also on the debit side of the balance sheet. So please take note, do not include it in or post it in the adjustments column. So I think I made myself clear. So that's all for this discussion. Thank you and God bless. Stay safe, everyone.